Welcome to Common Sense Investing. My name is Cameron, and today I'm going to introduce you to a new microcap stock for this channel. Can I add today's stock to my list of top stocks which are doing exceptionally well in 2024? Congratulations to ADF Group shareholders. Because ADF Group just solidifies what I am looking for on this channel, which is revenue growth, multiple growth, earnings growth, and cash growth. If we could find those things, you have the perfect company, the perfect stock. Now today, Simply Wall Street, possibly the worst software program in the world for microcap stocks, says this company's financials are too obscure to link with their current share price momentum, what's in store for this stock, and the company themselves don't tell us much, talking about their Q1 2024 earnings, revenue, adjusted EBITDA. The only thing that they say is that cash is up, and that leaves me confused. Share price on this stock is down 60% since the COVID era. But is there potential here? Because in 1 year it's up 19%, and year to date in 2024 up 81%. As always, I am not a financial advisor. I'm definitely not your financial advisor. I am just one average retail investor who enjoys giving my opinion on stocks, and this is not financial advice. And today I'm going to give my opinion talking about the risks of investing in this company, the potential rewards, and at the end of the day, let you, good investors, decide what you think of Eastside Games Group, trading under the ticker EAGR in Canada on the TSX. Let's go find a great penny stock. So what does Eastside Games Group do? They are a leading mobile game platform technology company and development and publishing group powerhouse, creating legendary games. What legendary games? Are we talking about World of Warcraft or N64's 007? I feel pretty old right now. I don't know what a legendary game is anymore. I'm just too old. But speaking of old, these probably aren't legendary games. I mean, the Trailer Park Boys, The Office, some of these are giving me flashbacks even. They have two studios, Eastside Games and Leaderly, that is creating independent and profitable games for the Google Play Store and the App Store. They have recurring revenue, they have revenue diversification as they grow their basket of games and offerings. They have a merger and acquisitions agenda, and they can scale without too many additional costs. And while Dragon Up might not be this guy's, favorite game out there right now with this pug-looking dragon thing, at the end of the day, the company has won a lot of awards and recognition. Overall, this is not something that I understand. Eastside Games Group, their games, Trailer Park Boys, OK Pug Up Dragon, whatever, probably not games that I'm going to play. In fact, I don't remember the last time I actually downloaded and played a game on my iPhone. But that's okay. If I only invested in what I truly understood, I'd only be invested in old man stuff, right? Costco, Home Depot. But at the end of the day, this is a very simple business strategy. They develop games. If the games are good, people buy the games. They get marketing and advertising from the games, and they make money. It's not very complicated. What will drive share price in the future is whether or not this is profitable. Growing revenue, growing earnings, growing cash, those are things ultimately that I will be looking for, and not so much whether I'm going to run out and download the Trailer Park Boys app, which I might do right now just to see. So let's look at their first quarter 2024 financial results, try to break it down here for you. They have pretty decent assets here. Current assets include $7.2 million in cash, $8.2 million in trade and other receivables, some other government-assisted receivables, and prepaid expenses and deposits for $22.4 million, and actually decent current assets. Now, they do have some intangibles and goodwill that I don't love. All total, they have $69 million in assets, but really this is the number that I'm looking for here. $22.4 million in current and pretty decent current assets. That's over top of $11.7 million in trade and other payables. And really no debt here. Nothing that's scary. They have some deferred income tax, $2.5 million in long-term liabilities. But overall, this is a good start to the company, and other than some of the intangibles and goodwill, a pretty attractive looking balance sheet. I have to point out there's been no share dilution. As of January 1st, 2023, 81.5 million shares. As of March 31st, 2024, 81.5 million shares. So they're checking off a lot of boxes. Cash all important cash. And the first thing to notice on this is net and comprehensive income of $1.8 million and a significant improvement from last year, losing $1.1 million. On top of that, talking about improvement, cash flow moving from negative $1.87 million last year to a positive operating cash flow of $3.4 million in March 31st quarter 2024. That is impressive. At the end of the day, their cash improved. Beginning of period, $5.2 million, went up $2 million in the quarter. They now have $7.2 million in cash. Cash, cash, cash. I love it. But look, we need to stop here. All of this sounds great. Is it too good to be true? This should be a $100 stock. They're producing cash. They have a nice balance sheet. What could possibly go wrong? Mostly the revenue from gaming, revenue from advertising, both are down year over year, going from 18 million to 15.9 million, advertising going from 6 million to 4 million, and all total revenue going from 24.2 million to 20.8 million. So this, not super happy about this. This has to change. But like so many other companies that I've seen in 2023 and 2024, improving their margins, improving their earnings during this time. Despite the revenue going down, they're reducing their expenses. Their gross profit, despite the revenue being down, almost $4 million, their gross profit was actually only down about $1.3 million. And then, of course, when you look at their expenses, they actually went from last year $15.9 million in expenses to $11.8 million in expenses. And at the end of the day, despite declining revenue, they went again from having a net loss to having a net income, a net profit. So this really gets me thinking, right? Typically, I'm looking for a company 15% revenue growth or higher, 25% is preferable, 35% or higher is perfect. If you go look at some of the videos I made recently, high revenue growth is what we need to get that 10x microcap stock. And right now, currently, with this company, they simply don't have it. However, at the same time, sometimes this is needed for companies to realize they have to run the company better and they have to worry about those bottom line earnings. And so far, it seems like Eastside Games is doing a fantastic job of this. Really, all this comes down to right now, can they make the impossible possible? Can they do the same thing, reducing their expenses, focused on earnings growth? Can they do that and increase their revenue? Now, the good news is I don't know if the revenue is going to go up yet in the future. However, it does look like it bottomed out. These are the quarter over quarter numbers, and you can see revenue has been at that $20 million mark since about the middle of 2023. You could see the same thing here on the chart. And again, one of the things you notice though, even though the revenue is down from where it was over here, their expenses are significantly down too, right? So even though the revenue is down, they're making earnings. However, we would like to see this trajectory that they were on back during COVID. If they could get that again and continue to keep these expenses low, that is what I'm interested in. So growth, can they get it? What does the company say about growth in 2024? Quite a bit. I mean, I think they obviously recognize the problem and are trying to convince shareholders to stay and attract new investors, which seems to be working because their share price is going up. But they have a list here of games that they have either released recently or are going to release in 2024, including a collaboration with Hasbro on an upcoming mobile game, Power Rangers Mighty Force. Power Rangers. Was that 1990s? I actually remember that one, right? That is set to launch in Q2. Q2 is coming up. They've got a whole list of games here, though. Potentially more revenue growth and profits in the future for this company. So all that information has to be factored in here. If you've been watching my videos recently, I've been having a lot of discussion of this data here from Ryan Telford, talking about how in the short term, in 2 years, multiple expansion can really drive up the share price of a stock, with 50% of the stocks relying on multiple expansion for significant gains. However, long term, we're looking at earnings growth is king. So if we look at Eastside Games Group, Group, there's a couple things here to consider. One is a $69 million market cap. Valuation doesn't look too bad, right? They've started making earnings and they've started making EBITDA. So we can actually look to some of these numbers and assess whether or not they're low, high. That is up to you. That is your personal preference as an investor. Right now, they have a price to sales of 0.83, which tells me that shareholders are pricing in probably limited or no growth at this moment. This is all over top of that 81.5 million shares. However, people might like this with 60% insider ownership, a float of only 28.9 million shares. And I mean, again, cash, right? No debt, cash flow. What more can we ask for, right? If we were looking at this company and it was growing revenue, this would be absolutely perfect. So really, is that it? All the fantastic things the company is doing, everything I've showed you. The only kind of red flag here is quarterly revenue growth, down 14%. Can this change? Can this stop? And getting to my reward over risk, their revenue is flatline. That's a risk. I've seen companies that just have the same revenue for years and years and years. I obviously would not be bullish if that happens to Eastside Games Group. Do the games suck? I don't really know, except to look at their revenue. The proof that the games will actually be good, that people will want to buy them, use them, is their revenue will start going up. That's what I rely on. Now, the rewards here are actually pretty good. They've shown significant bottom line improvements. This is actually a growing profitable stock, even though their revenue isn't growing recently. They've had no share dilution. The company thinks they're undervalued and has actually been buying back a significant number of shares. They're producing cash. Are they at an inflection point? That's the big question. Can they turn around their top line? Can their income statement show revenue growth instead of a declining or flatlining revenue? This has been a beat up stock in 2023, but I wouldn't throw it in the garbage yet. I am putting this company, Eastside Games Group, on my watch list. As always, thank you for your time. You've been watching Common Sense Investing. I hope to see you again for the next one.